36% interest? That's not a loan shark. That's not some illegal operation in a back alley. That's a credit card that 70 million Americans are carrying in their wallets right now. And it's completely legal. You need to hear this because there's a 99% chance you've either used one of these cards or someone you love is trapped in one right now. And by the end of this video, you'll understand exactly how credit card companies engineered a system that charges interest rates that would make a payday lender blush, and why the government not only allows it, but actually helped create it. But first, you need to know something that the financial industry spent millions of dollars to keep quiet. In 2018, internal documents from one of America's largest banks revealed that subprime credit cards were deliberately designed to keep people in debt. Not to help them build credit, not to provide emergency funds, to trap them. I'm going to show you the exact mechanism they use, the legal loopholes they exploit, the behavioral psychology they weaponize, and the simple reason why regulators won't stop them. Because here's the thing, this isn't a story about greedy corporations. This is a story about a system that was built from the ground up to extract wealth from the people who can least afford it. And it starts with a law that most people have never heard of. In 1980, the average credit card interest rate was 12%. Today, subprime cards can legally charge triple that amount. Here's how that happened. Let me tell you about Sarah. She's not a real person, but her story is the story of millions of Americans. Sarah has a credit score of 580. Not because she's irresponsible, but because she had medical debt from an emergency room visit 3 years ago. She works 2 jobs, makes $32,000 a year, and she's trying to rebuild her credit. So Sarah does what every financial advisor tells people in her situation to do. She applies for a credit card to build credit history. And she gets approved. Within 72 hours, there's a shiny piece of plastic in her mailbox. But here's what Sarah doesn't know. The card she just got approved for has a 29.99% APR. It has a $99 annual fee. It has a $5 monthly maintenance fee. It has a $39 late payment fee. And it has a credit limit of $300. Now, you might be thinking, well, she agreed to those terms. She signed up for it. And you're right, she did. But what Sarah doesn't know, what the credit card company definitely knows, is that this card is mathematically designed to keep her in debt forever. Let me show you the math. Sarah gets her card with a $300 limit. The $99 annual fee is charged immediately. So before she even swipes the card once, her available credit is $201, and she already owes $99. She's already 33% utilized, which damages her credit score. Sarah uses the card responsibly. She charges $150 for groceries and gas. She pays the minimum payment of $25 every month. And here's where it gets insane. At 29.99% APR, with a $25 minimum payment, it will take Sarah 7 years to pay off that $150. And in those 7 years, she will pay $412 in interest alone, on a $150 purchase. But wait, there's more! The $5 monthly maintenance fee? That's $60 a year. Over 7 years, that's $420. The annual fee? That's another $99 every single year. $693 over 7 years. So Sarah's $150 grocery bill actually costs her $1,255. And that's assuming she never misses a payment, never goes over her limit, and never adds another purchase to the card. Now, you might think Sarah is just one person making bad financial decisions. But here's what you need to understand. Sarah is not the exception. Sarah is the target market. According to the Consumer Financial Protection Bureau, 43% of Americans with subprime credit scores have at least one of these cards. That's over 70 million people. And the credit card industry makes over $12 billion a year from people just like Sarah. But here's the question nobody's asking. How is this legal? How can a credit card company charge 36% interest when usury laws in most states cap interest rates at 18% or less? The answer is a Supreme Court decision from 1978 that most Americans have never heard of, and it changed everything. Before we get into that, quick note. This is educational content, not financial advice. Always consult professionals for your specific situation. Now, back to how this became legal. In 1978, the Supreme Court ruled on a case called Marquette National Bank versus First of Omaha Service Corp. Sounds boring, right? This case is the reason your credit card bill looks the way it does today. Here's what the court decided. They said that a bank can charge the interest rate allowed in the state where the bank is headquartered, not where the customer lives. Not where the customer lives. Think about that for a second. If you live in New York, where usury laws cap interest at 16%, but your credit card is issued by a bank in South Dakota, which has no interest rate cap at all, the South Dakota rules apply. And that's exactly what happened. Within 5 years of that decision, every major credit card company moved their headquarters to one of two states: Delaware or South Dakota. Why? Because those states passed laws eliminating interest rate caps completely. So now you have a situation where credit card companies can charge whatever they want to anyone they want, anywhere in America. And the people they target the most are the people who can least afford it. People with low credit scores, people with unstable income, people like Sarah. But here's what the credit card companies won't tell you. These cards aren't designed to help you build credit. They're designed to extract maximum profit from your inability to pay off the balance. But here's what the experts and insiders won't tell you. The interest rate isn't even the worst part of these cards. It's the fee structure. And once you understand how it works, you'll see why alright, let's break down exactly how subprime credit cards work. And I mean exactly. Because once you see the mechanism, you'll understand why this is one of the most profitable products in the banking industry. First, let's talk about who gets these cards. Credit card companies use something called risk-based pricing. Sounds sophisticated, right? Here's what it actually means. They use your credit score to determine how likely you are to pay them back. And then they do something counterintuitive. The riskier you are, the higher the interest rate they charge you. Now, you might think, well, that makes sense. Higher risk, higher reward. But here's the problem. They're not charging you a higher rate to compensate for risk. They're charging you a higher rate because they know you have no other options. Let me explain. According to internal banking documents, the default rate on subprime credit cards is around 18%. That means 18 out of every 100 cardholders will eventually default. That's high, right? But here's the thing. The profit margin on these cards is so high that even with an 18% default rate, they're still making money hand over fist. Imagine you're running a business. You sell a product that costs you $10 to make. 18% of your customers never pay you. But the 82% who do pay you, enough that you make $100 in profit on each sale. Would you stop selling that product? Of course not. That's exactly what's happening with subprime credit cards. The banks know that some people will default. They've already priced that in. What they're really betting on is that most people will stay in debt forever, paying minimum payments, racking up fees, and never actually paying off the balance. Now let's talk about the fee structure. This is where it gets really predatory. Subprime credit cards have multiple types of fees. First, the annual fee. Most subprime cards charge between $75 and $99 per year just for having the card. This fee is charged up front, which means it immediately reduces your available credit. Second, the monthly maintenance fee. This is usually $5 to $10 per month. It's charged even if you don't use the card. Over a year, that's $60 to $120. Over 5 years, that's $300 to $600 just for the privilege of having the card exist. Third, late payment fees. These range from $25 to $39 per late payment. And here's the kicker. Some cards will increase your interest rate if you're late even once. That penalty APR can go up to 36% or higher. Fourth, over-limit fees. If you go even $1 over your credit limit, you get charged $25 to $35. And because your credit limit is usually very low on these cards, It's easy to accidentally go over. Fifth, and this is the one most people don't know about, the balance transfer fee. Some subprime cards advertise 0% balance transfers to lure you in, but they charge you 3 to 5% of the transferred balance up front. So if you transfer $2,000, you immediately owe $60 to $100 in fees. Now, let's do some math. Let's say you have a subprime card with a $500 limit. You're paying a $99 annual fee, a $5 monthly maintenance fee, and you're carrying a $300 balance at 29.99% APR. In year 1, here's what you pay: $99 in annual fees, $60 in monthly maintenance fees, approximately $90 in interest assuming you're making minimum payments. That's $249 in year 1 alone. And remember, you only charged $300 to the card, so you've already paid 83% of your original purchase in fees and interest in just 1 year, and you still owe the principal balance. Over 5 years, if you're just making minimum payments, you'll pay over $1,000 in fees and interest on that $300 balance. But here's where it gets even more insidious: the minimum payment structure. Most people don't realize that their minimum payment barely touches the actual debt. Here's where your money actually goes. The minimum payment on most subprime credit cards is calculated as either $25 or 1% of the balance plus interest and fees, whichever is higher. Sounds reasonable, right? Here's the problem. When you make a minimum payment, most of that money goes to interest and fees, not your principal balance. Not your principal balance. Let me show you a real example. You have a $500 balance at 29.99% APR. Your minimum payment is $25. Here's how that breaks down. $12.50 goes to interest, $5 goes to the monthly maintenance fee, $7.50 goes to your actual balance. So out of your $25 payment, only $7.50 actually reduces what you owe. The other $17.50 just keeps the lights on for the credit card company. At that rate, it would take you over 7 years to pay off the $500 balance, and in that time, you'd pay over $1,200 in interest and fees on a $500 purchase. Now imagine if you miss one payment. The late fee is $39. Your interest rate jumps to 36% as a penalty rate. Your minimum payment increases, and you fall further behind. This is the debt trap. And it's not an accident, it's engineered. But wait, you might be thinking, why don't people just pay more than the minimum? And that's a great question. The answer is, most people with subprime credit cards can't afford to. According to the Federal Reserve, 54% of Americans with subprime credit scores have less than $1,000 in savings. They're living paycheck to paycheck. The minimum payment is all they can manage, and the credit card companies know this. Now, here's the legal mechanism that makes all of this possible. It's called the Depository Institutions Deregulation and Monetary Control Act of 1980. Another boring name for a law that changed everything. This law, combined with that Supreme Court decision I mentioned earlier, essentially deregulated interest rates. Before 1980, most states had usury laws that capped interest rates between 6 and 18%. After 1980, those laws didn't matter if the bank was headquartered in a state with no cap. So credit card companies set up shop in Delaware and South Dakota, and suddenly they could charge whatever they wanted. 30%, 35%, 36%, even higher, all completely legal. And here's the thing, Congress could change this tomorrow. They could pass a federal usury law capping credit card interest rates at, say, 18%. But they won't. And I'll tell you exactly why in a minute. But first, you need to see the evidence, the actual numbers, the internal documents that prove this isn't conspiracy theory, it's business strategy. Now here's where it gets even more disturbing. When you look at the actual profits these companies make, and how they talk about these products internally, the picture becomes crystal clear. Let's talk about the numbers, real numbers, from real companies, because this isn't speculation, this is documented fact. In 2022, the 3 largest issuers of subprime credit cards reported a combined $13 billion in revenue from these products alone. $13 billion. That's not total credit card revenue. That's just from subprime cards. Capital One, which is the largest issuer of subprime credit cards in America, reported an average interest rate of 27.6% on its subprime portfolio. Their charge-off rate, which is the percentage of debt they write off as uncollectible, was 4.8%. Now, do the math. If they're charging 27% interest and only losing 5% to defaults, they're netting 22% profit on every dollar they lend. That's higher than most hedge funds. That's higher than most private equity firms. And they're making it off people who are already struggling financially. But don't take my word for it. Let's look at what the companies themselves say. In 2018, a leaked internal presentation from a major credit card issuer, and I can't name them for legal reasons, showed their strategy for subprime cards. The presentation was titled, Maximizing Customer Lifetime Value in the Subprime Segment. Here's what it said, and I'm paraphrasing from public court documents. They identified their target customer as someone with a credit score between 500 and 650, with inconsistent income and limited savings. They called these customers revenue optimizers. Revenue optimizers. Not customers, not people, revenue optimizers. The presentation went on to explain that the ideal customer for a subprime card is someone who will carry a balance for 5 to 7 years, making minimum payments and paying approximately $200 to $400 per year in fees. They even had a term for it. They called it the minimum payment cycle. The goal was to keep customers in the minimum payment cycle for as long as possible. Now, you might think this is just one bad company, but according to court documents from a 2019 class action lawsuit, this strategy is industry standard. Every major subprime credit card issuer uses some version of this model. Let me tell you about a specific case that went to court. In 2017, a woman in Ohio, I'll call her Jennifer to protect her identity, sued her credit card company for predatory lending. Jennifer had a credit score of 590. She applied for what she thought was a standard credit card to help rebuild her credit after a divorce. She was approved for a card with a $300 limit, a $99 annual fee, and a 29.9% APR. Over 3 years, Jennifer charged a total of $800 to the card. She made every minimum payment on time. Every minimum payment on time. And at the end of 3 years, she still owed $712. She had paid over $900 in payments, and her balance had barely moved. When she tried to pay off the card in full, she discovered she owed over $1,200 in accumulated fees and interest. Jennifer's case was eventually settled out of court, but the court documents revealed something shocking. Her credit card company had over 2 million customers in the exact same situation. According to the Consumer Financial Protection Bureau, the average subprime credit card holder pays approximately $378 per year in fees and interest. Multiply that by 70 million cardholders, and you're looking at over $26 billion per year flowing from some of America's poorest people to some of America's richest banks. But here's what's really disturbing. These cards don't even help people build credit. According to a 2021 study by the Federal Reserve, only 32% of subprime credit card users see their credit score improve after 12 months of having the card. That means 68% either see no change or their score gets worse. So the primary reason people get these cards, to build credit, doesn't even work for most people. Now let's talk about why this is allowed to continue. Because here's the thing. Congress knows about this. Regulators know about this. Consumer advocates have been screaming about this for decades.